Welcome to the Defi podcast, where we attempt to imagine the future of crypto, because foresight is what makes great investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment. All statements made by hosts or guests are strictly beliefs or point of views and are not recommendations to buy, sell, or hold any security. Hosts or guests may hold certain securities discussed in this podcast.
Hi everyone, welcome to the show. I'm JF, I'm the head of growth at Moremoney Finance. I'm an ex-founder and CFA Charterholder. My co-host, Jared, is a crypto and equity trader and an ex-founder. And today we have the pleasure of welcoming CanuckLink, who has recently written a very good Substack that we are going to discuss today. He's a crypto native and enthusiast. Welcome, Canuck.
Yeah, thanks for having me. It's really great to be here. Big fan of your pod, so it's a real honor. I listen to you guys weekly and really excited to kind of delve into DeFi with both of you.
Awesome. So today we're going to talk about your last Substack, which is quite complex and in-depth and has a lot of different ideas and is actually very important because it really sort of defines like where does the value accrue in the ecosystem, right? Does it accrue to the really, really base layer, like let's call it, I don't know, Avalanche, or does it accrue to something that's built on top of it, but is becoming, to me, sort of the middle? I know that's not how you called it in the article, but something like Platypus, or does it accrue to something building on top of Platypus like Vector, Echidna, or Yield-Yak? And I don't know the answer to this question, right? So I think that's what it's going to make for a very
Yeah,
good...
I don't know the answer to that question either, so it's funny. Actually, just to clarify something, I know I kind of allude to the FAT protocol thesis from Union Square Ventures. I think my thesis is very specific to kind of this VE model of tokenomics and only kind of looks at the DeFi primitive, the yield booster built into the middle, and things that are built on top, usually kind of bribe voting systems and things like that. I don't really have a comment on the FAT protocol thesis. I think that still holds true. I think, Avalanche is worth more than the DeFi protocols currently.
Right. So before we get into the specifics, maybe we could talk a little bit about what Platypus is and the different protocols building on top of it, like Vector and Yield-Yak. Jared, could you give us a quick intro on those?
Sure, yeah. So Platypus is going to be the place on Avalanche that you're going to go to exchange stablecoins. It is a low slippage stablecoin exchange. You're going there specifically for efficient trades between like assets. So different kinds of stablecoins, potentially, different kinds of maybe even Bitcoin tokens in the future. Who knows? We'll see. We're going to get into talking about the things that are building on top of this, like Vector and Echidna, which are protocols to take the governance tokens created by the underlying protocol and kind of maximize the efficiency while giving users a kind of an easier entry to the system and optimizing their yields.
Can you tell us a little bit about maybe we can open with the FAT thesis in a non-crypto context and then bring it to crypto?
Yeah. So, just a quick overview of what a FAT thesis is. So when I say FAT in the FAT middle thesis, what I'm referring to is when you have this ecosystem of different layers, where within the ecosystem do I see the most growth? Do I see the potential for the largest market caps and for the largest demand for, say, the underlying tokens or the governance tokens? And, this article, although it focused on convex and curve as the use case example, it's really blown up in the Avalanche community. And I see people posting it, not only Platypus and Echidna and Vector, but also in like Yeti Finance and like other more Avalanche focused discussion groups. So I first really appreciate the Avalanche community for supporting me and all of that. But anyways, so before I go into the FAT middle thesis, let me just take a step back and kind of give a little bit of a history of DeFi tokenomics and, where we've been, where we're coming to. So originally, a lot of these DeFi protocols didn't have tokens associated with them, but a lot of them had a lot of trouble gaining liquidity and things like that. It wasn't until SushiSwap where you had an AMM, and to attract liquidity away from Uniswap, what they did was they started offering this reward token called Sushi. So people would become liquidity providers in Sushi and basically get this token as a reward. And what that led to was people kind of dumping that token on the market. So the next iteration was people staking the token. And while that kind of solved the problem for a little bit, it also led to dumping on the market as well. And there's actually a recent article from Kobe from the Up Only podcast, which talks about his concerns about staking regarding ApeCoin, which I highly recommend people read. But so the next iteration that came about is this kind of vote escrow model. So in an attempt to prevent loss of value of these tokens, vote escrow, what it does is it combines the reward with a time lock plus a governance, essentially kind of like what I described in my article, essentially creating a ticking time bomb instead of an immediate dumping of reward tokens. So in Platypus, when you provide liquidity, you get these PTP reward tokens. And then when you stake those PTP reward tokens, you accrue VEPTP. And the more VEPTP that you accrue, the greater the boost that you get in your reward. So this has allowed for protocols to be built on top, and they take your PTP and they give you an automatic boost if you provide liquidity through them.
Can you expand on the sorry to cut you off, just
Sure.
The time bomb issue? What do you mean by that exactly?
Yeah, so the time bomb issue is that this is kind of going into the question of actually providing utility to these tokens. So because the vote escrow model uses a time-dependent lock or time-dependent accrual of rewards, you kind of play this game theory that like, okay, if I lock it long enough, I'm going to get enough rewards. But the downside is that if for some reason there's a huge market crash and everybody starts selling off PTP, people are going to start unstaking them and they're going to start selling those off as well. So it's not an immediate dumping, but there is a potential for a future dumping because this is not real utility of their token, right? It's kind of creating steps and creating a lot of different things that kind of lock it up and give you governance and things like that.
So we've sort of set up the stage for why we are getting to a place where we are doing vesting tokens, correct?
Yeah. So in our evolution of DeFi tokenomics, we've essentially come to the stage where, we have vesting tokens and we have protocols built on top of those vesting tokens, which will lock those tokens in forever, right? So Platypus tokens and Echidna and Vector are locked forever, right? So this kind of creates a little bit more of a stability and also creates a demand for these kind of middle layer protocols.
So the value therefore would theoretically accrue to Vector and Echidna and not the base layer, which in this case is Platypus. Is that the basis for the argument?
Yeah, so that is the basis for the argument. And in the article, I kind of provide evidence as well that, Convex's market cap is much larger than Curb's now. And, I'm kind of predicting similar things will happen on Avalanche with Vector and Echidna. And then furthermore, I put the price chart in for kind of the past month. I mean, right now we're kind of in a bear market, but we saw Vector kind of blow up in price last month, and as well as Convex relative to Platypus and Curve.
So I can definitely see an argument to be made where the way you look at Platypus, it's sort of tokenomics model. You get no immediate sort of value from owning or staking Platypus on its own. So it kind of creates an interesting scenario where if you can do more with it, for example, somebody like Vector is able to kind of open up the system where people can now have the option of monetizing their Platypus that they couldn't do before. So I think that does open up an interesting possibility for a protocol like Vector to gain additional sort of interest based on the fact that you can do more with vector than you can do with just Platypus.
Yeah, definitely. I mean, that's kind of the incentive of locking your Platypus in there forever. You get a certain percentage of the protocol revenue plus vector voting tokens, which you can lock up even further. And, this kind of creates a flywheel effect where, you lock up your Platypus, you get part of the revenue in Platypus, you get vector tokens, you lock up again those Platypus tokens in vector, and then you lock up the vector tokens for voting on vector, which will control Platypus and so on and so forth. So it kind of, this flywheel effect kicks in and, people start, locking this and locking that. And then all those tokens are taken off the market. And we know what happens after that. The price goes up and the demand goes up.
So in the article, you go over 5 different points in terms of boost, deep liquidity, asymmetric defense, bribes, and tokenomics. Do you want to quickly cover some of these here?
Yeah, for sure. So I make the article, in the article, I make the argument as to, why do I think protocols like Vector and Echidna have the greatest growth potential? And the first, like we just discussed, is the most obvious. You have a boost service. So as a liquidity provider, you don't need to deal with Platypus tokens. You just go to Vector or Echidna and you put in your LP and you immediately have a, significant boost. And it's over 10% right now on both. The second, as Jared said, is that Platypus alone, like PTP token alone, does not do anything other than, lock up and give you a boost. But in Vector and Echidna, you lock up your PTP over there for, XPTP or ECD-PTP. And then you begin to collect revenue from the protocol as well as voting tokens within those protocols. The next one that I discussed is deep liquidity without dilution. So from a stablecoin perspective, say I'm Terra Luna and, I want to have deep liquidity in the UST pools in Platypus. How do I attract that liquidity, right? One way is to offer my own tokens, but then, I end up diluting my own tokens. The other way is to control the gauge on Platypus so that PTP tokens are directed towards the UST pool, and thus it attracts more liquidity for my UST pool. And for stablecoins, for them to hold peg and for them to really be useful in the greater DeFi space, they need strong market making, they need low slippage, and they need deep liquidity and utility. And the third point was asymmetric defense. So Echidna and Vector control 40 to 50% of the circulating supply of PTP tokens. There's no point in kind of going up against them because then you're going to have to market buy essentially the rest of the PTP tokens. It's so much easier to just align with them, bribe Vector or Echidna token holders or token lockers and control the vote of them. The fourth that I mentioned was bribes. So now once you build out this middle layer, you can build up another layer on top where you can have a protocol that essentially gives bribes to Echidna and Vector holders. So as it sounds, you're being paid to vote as they want so that you can control the gauges in which pools they go to. And so something like Terra Luna will give money to Vector holders, for example, and ask them to vote for the gauge to the UST pool. And for somebody who has a voting stake in Echidna or Vector, this is a huge advantage because it creates another revenue stream for them. And then finally, the point that I make is tokenomics is that oftentimes these middle layers are kind of capped at 100 million, 300 million tokens, which is often far less than the Platypus token cap.
I think it's actually interesting. Once let's say the Platypus wars are over, we might see people starting to war for these different sort of Platypus L2s, so to speak. And what that might do to the valuation of, for example, Vector and Echidna. Because if somebody wants to get their token listed and they want to fight over the gauges, they're going to have to go through this avenue.
Yeah, for sure. This may be a conflict of interest to you, JF, but I know that Moremoney has been buying up Vector and Echidna, so they don't need to do bribes. And from, I guess, your perspective, I think that's a very strategic move that, I think you guys are like a newer and smaller lending market with a stable coin attached. You're not Do Kwon and Terra Luna. So from your perspective, I think that's a very strategic move. Wouldn't you say, JF?
Yeah, we're not VC backed, so we have, I guess, somewhat less means. So we need to be very aggressive and strategic and smart. Um, I think there's sort of three ways that you can, if you're a stable coin, and this sort of something that there may be potentially a Medium article coming out about this soon from Moremoney. But the basic idea is you can influence voting because you want the underlying pools to be well funded in emissions and rewards so that people want to put money there and so that your stablecoin is liquid, right? So that's sort of, to me, the first part of the Platypus war is the one that we've seen unfold so far, where you have Vector, Echidna, and Yieldiac fighting each other for sort of the top position. But I think there's a governance war coming where different stablecoin protocols are going to be fighting to own Vector, Echidna, and Yieldiac. So it's very bullish for those protocols. And that's because there's kind of three ways in which you can influence the governance. You can buy Platypus tokens off the market and do it that way. Or you can own one of these other layers, which sort of separate the voting from the boost utility. And you can get it, for example, with Vector, you can get it straight through the VTX token. So it, I believe, will come out to be cheaper to influence that way. And then the third way is to bribe the VTX or ECD token holders in the future through one of the means that you've discussed earlier, like Votium, which I don't think you can do yet anyway. So it's sort of in the future. And the Moremoney core team has been buying these protocols so that we can have a say in the way that the underlying pools are going to be rewarded, which is very important for any stablecoin protocol. Yeah, that's a very important point.
Yeah, no, I thought it was very smart on the part of Moremoney to kind of get in early, because right now there is no governance, and I think Platypus has said that their estimated launch is Q2 of 2022. So we'll see that happening. And I think, both Echidna and Vector combined, I think they're very close to reaching 40% mark, or they're at that point. And like you said, they have asymmetric defense that it's going to cost you way more to go against them than it is to just take control, especially at these early stages.
I'm curious what you both think about what percentage of the PTP is Echidna and Vector going to own in the future? So right now we see what it is, but there's going to be a lot more PTP emissions. How is that going to play out?
I'm expecting them to eat up a very large portion of the market at the rate that they're going. And this is like something that we talked about with Rev on our last, one of our last podcasts, when he was talking about the fact that over time, people who are currently staking will eventually run out of the time limit to accrue more VEPTP on top of their staked Platypus. And so there could be some point in the future, while these protocols continue to, Vector and Echidna, that is, they'll continue to gain more and more and more VEPTP over time. They're getting the emissions that are going to be restaked into the protocols, and they're getting just more users coming to their platforms. And so I think they're going to eat up a very large proportion of what is available. If you look at them, both of them right now, I mean, Vector almost has 5 million Platypus deposited into their system. And Echidna has just over 4 million Platypus. And so between the two of them, they're right around like 9, maybe close to 10 million Platypus soon, and the total supply of Platypus is only 24 million right now. And so I think that's just going to continue to grow. They could be well over 50%, within a few months, I think.
Yeah, I 100% agree with Jared, and I can see both Echidna and Vector owning, 60, 70% in the future. And not just because of that. The other thing is that the way that they're specifically designed is that, when you put Platypus into those protocols, they're blackholed forever, right? While at a user level, if I have Platypus staked on Platypus platform itself, I gain a PTP token, and as an individual, I may want to take some money out of that. So I may sell that PTP on market, make some USDC, and so on. For example, in Vector, one of the rewards that you get when you stake Vector token is their Platypus derivative XPTP, which suggests that what the protocol is doing is they're taking the PTP that they make from revenue, they're blackholing it into their own protocol, and then they're giving you the derivative as a payment. So over time, that growth becomes exponential, which we may or may not see at the user level in Platypus itself, because, like I said, users will want to take out their rewards and buy Lambos and whatever else crypto Twitter wants to buy.
I'm going to refer you guys to the panel. How would the panel think about a situation where, let's say 90% of the PTP is gone in blackholed, and there's only 10% PTP on the market that hasn't been bought up by one of these protocols? What happens to the price of PTP at that point? Does it actually, are people fighting over it because there's so little out there, or is everyone just happy, using Platypus through these other platforms and there isn't that much demand for it? What do you think?
I think it inevitably goes to the proverbial moon, because
it's a pretty clear guideline, and
yeah.
it's
Well,
not a
because
clear price target, but yeah, we get your position.
Yeah. So what happens when, like, in a hypothetical scenario, when 90% is locked up? The price can go up, but there are other factors that kind of come into place. The gauges are still running, so there's still a very high emissions of PTP token that is still being paid to the liquidity providers, both at the PTP level as well as the kind of middle level with the Echidna and Vector, and I think those people are still going to sell. So there may be a growth, but there may also be kind of a stabilization. And, we're seeing that in Curve as well, where, when there's low supply, there's this bump up, but then, people kind of sell off as well, because what's the point of holding those tokens? Because the more valuable token is the convex token, where you can vote and you can actually control those gauges, and that's what we see in what I predict to see in Vector and Echidna.
So you guys are maybe disagreeing a little bit here.
Slightly. I think it's going to go up because the value of the token is going to continue to rise in terms of what you can do with it. I think when you're able to monetize this token, once these platforms have, let's say, billions in deposits, each Platypus is going to be able to return greater yield. I'm sort of hypothesizing here, but I think the yield for a Platypus token is going to go up over time. And because of that, its value will also go up over time, which will keep their, sort of percentage income rate at like a variable level. I guess we're going to wait to see what that is, but I'm sort of estimating this to be similar to how you look at VECRV is going to give you, roughly about a 5% return just in stablecoins from the protocol over time.
Why would you want to use the PTP token instead of the VTX or Echidna token? At the beginning, it doesn't really matter, right? So even today, if you're picking up a PTP token, the VTX token hasn't had 10 months to accrue, so they don't have a huge advantage on you. But once we cross that 10-month threshold, why would anyone want to actually go to Platypus and not go to Vector and use the Platypus that they have already accrued?
I don't have a good answer for that, actually. We're going to have to wait and see how the sort of deposits play out over time and what their TVL looks like. It could be the case that as they continue to accrue a massive amount of VEPTP, their stablecoin deposits grow so quickly to just because the rates that they're able to offer are going to be so good, that it could depress the APR that you're able to get out of the system, even with, their maxed out VEPTP. So if you went and did it on your own and you were able to secure a large amount of PTP, you could maybe still find a better return on your own than going with them.
Yeah, but like people in the underlying who are staking in Platypus now and not staking in Vector or Echidna, I think those people are kind of outlier cases because most of those people are kind of like whales who really don't care about dumping Platypus and are getting huge APR APY. But I think more users that are coming on, they don't want to wait to occur that VEPTP. So they're just going to go to Echidna and Vector and stake there and then build up there.
Yeah,
But
so I mean,
we'll see in the
I
future.
think we're gonna get into some sort of equilibrium where I agree with what Jared said. If the returns are more attractive on Echidna and Vector, at some point there's going to be too much in deposits, and then it's actually going to be advantageous to buy your own PTP. So, as well as these platforms are going to do, I think there's always going to be some demand that will be like an equilibrium demand when there's just too much going into one side. There is going to be demand coming onto this other side, this PTP side. So, going back to the question where 90% of the PTP has been locked away and there's 10% left. I mean, I guess that 10% is going to continue to drive the price, right? So the demand for that 10% is going to drive the price for PTP altogether. And then you're going to get your diluted market cap metric, which is the metric that I usually look at. I don't really look at market cap. I sort of like to see how much the whole protocol is worth, especially in crypto where things, they emit their full token value like very fast over a couple of years, generally speaking. So that 10% is going to influence and drive the price for the whole protocol. And I guess the question I want to get to is at the end of the day, we've talked a little bit about it before, but where does the value accrue? Does it accrue to Vector and Echidna, or does it accrue to Platypus? Canuck, you think that is going to mostly accrue to Vector and Echidna, correct?
Yeah. And in my opinion, the evidence points to that way. If we were to take a curve and convex as a use case model, right? So like I'm very data driven in what I like to do, and based on the data, that's what we're seeing.
And Jared, where do you stand on this?
I still would tend to agree with that. I think most of the value is going to come in on the Vector and Echidna side, just because it's kind of creating that bottleneck where you can do sort of like A and B on Platypus, but you can do A, B, and C on Vector. And just because you have more options to do more things at potentially higher rates over time, on Vector and Echidna, I think they're going to continue to kind of be the sort of primary choice for people who want to like put their stablecoin somewhere or invest in one of these protocol tokens. It's just the ease of use is going to be more attractive than almost anything else.
Yeah. So, my opinion, without having done a ton of analysis on this, so I would, reserve myself, the right to change my mind here in the future. But I guess, from a bird's eye view, I think I'm very bullish on Avalanche, on Platypus, and on these other platforms we're building on top. I think each part of the ecosystem, if it's used, are going to be winners. Obviously, we want to know which one is going to win the most. Leaving the L1 Avalanche out of it and looking at Platypus and Vector, if I actually look at the charts that you posted in your article, I'm again drawn to fully diluted valuation. And when you look at the fully diluted valuation, the curve token has a much, it's essentially a little bit more double the size of convex, which sort of makes sense to me. I think essentially they're splitting the value between the different parts. So I again, bullish on all the parts, but I don't know that I would, deeply venture a guess that there's going to be a huge loser here on the side of Platypus or Curve.
Oh no, I mean I don't claim that there will be a loser in the base layer DeFi application, because if Platypus or Curve fails, then everything built on top kind of falls like a house of cards, right? So I mean, I kind of wrote that article to kind of put my investment thesis out there for somebody who's a more retail investor, and to say, okay, where can I put my money, where I can have a kind of a little bit of a risk-adjusted gain in this ecosystem. And for me, it was Vector and Echidna.
So can we quickly talk about the future of VE tokens in general? Because this idea is spreading to other parts of the ecosystem. And it may actually, on that basis, make me sort of evolve my view on what I just said a minute ago, where if you are now looking at other applications, then maybe a lot of the value of the whole ecosystem could accrue to these platforms, right? So, you may share the value between a Platypus and a VTX or an ECD, but if these platforms become specialists at doing VE tokens and they're doing it for other platforms than Platypus, this really actually changes the way you have to look at it.
Yeah, I'm super excited about that. There's still a lot of unknown factors. So you probably saw that Joe recently launched their VE token. You probably also saw that Vector launched a Joe rush to collect a VE Joe, and probably also saw that they locked up 3 million VE Joe in under 2 minutes. I was there. That was wild. That was, edge of your seat excitement for Vector and Trader Joe investors and things like that. So that was very exciting. And the other cool thing about Vector is I think they're probably the first convex fork to take up VE tokens from multiple protocols. I think the only closest thing is Redacted, which is not a convex fork. It's an Ohm fork that's actually built by the Ohm team. So for Vector, they kind of took a risk because now they're fighting wars on two fronts, right? They're fighting one war against Echidna, and then they're fighting another war against Yieldiac and Stake Hut and so on. But it seems the narrative within the market and the narrative within the community is that Vector is really trying hard to become a Avalanche kingmaker. Everybody was posting, Kingpin, like OX Ninja calls it Kingpin. But I personally call it a kingmaker. And, that narrative played very true to their success. And, right now they have over 9 million Joe tokens locked up forever. So that's interesting. But the other two that I also mentioned in my article was Yeti Finance. And I'm not too sure how Yeti is going to work. I've kind of been doing a more deeper dive into them because they don't really have a gauge system set up. So it's not really sure what incentives, these middle protocols may have to take them up and, how people will get bribes. And then the last one is Frax Finance on Ethereum, which is doing a lot of cool stuff and a lot of real great innovation over there. But I don't want to get into that too much.
Do you guys have an opinion as to why the VE tokens are sort of spreading across DeFi besides on these high efficiency AMMs?
I think it forces you to lock up the token. And so it causes a lot less of your tokens to be sold off to the market. And it incentivizes people to have long-term holds. Instead of just being able to get in, get out, lap up your 400% APR and then take all your earnings and dump back to the market. First of all, you don't have the option to do that, and you're incentivized not to do that because your earning potential is higher in the future if you don't.
Yeah, I agree that for these AMM tokens, they need to find a use case for it. And it's obvious that, simple governance is not necessarily the best use case for it.
So big picture, how do you expect Ethereum versus Avalanche to play out?
Oh, that's a tough question. Because I enjoy Avalanche and I enjoy Ethereum. You're talking to somebody who's kind of blockchain agnostic. So in Ethereum specifically, I think L2s are going to be a big part. And I see a lot of L2s becoming specific use cases for Ethereum. And I think Ethereum's big selling point is if you want to inherit Ethereum's base layer security, you build an L2 on Ethereum. And I think for Avalanche, I think the goal of Avalanche is to, and this is from Emin Gun's comments himself, that he's interested in kind of capturing everything of value. So I see subnets coming into play in Avalanche and not only DeFi, but GameFi growing on Avalanche and a lot of other value propositions growing on Avalanche as well. But the other take on this is, what happens with layer 0? What happens in interoperability between blockchains and things like that? So I see a future where, it may not even matter what blockchain you're on. You may just be hopping from subnet to L2s and things like that. So yeah, I kind of gave the more politically correct answer, mainly because I'm still a big Ethereum fan and still a big Avalanche fan. And, I think the Ethereum people and the Avalanche people can both hate me equally.
That answer is not acceptable on this podcast.
Of course not. Of course not.
Yeah. So on that note, if you're still watching the show, thank you. Please follow us on Twitter. Please follow us, subscribe to this podcast, and please give us a thumbs up if you're watching it on YouTube. And thanks for being here. See you next week.